Let me tell you something that the financial media will never say out loud, because if they did, their ratings would collapse and their advertisers would leave them overnight. The people who build real, lasting, generational wealth, I mean the kind of wealth that doesn't evaporate in a correction, the kind that compounds quietly for decades, those people are not on television screaming about the hottest ticker of the week. They are sitting in a room somewhere, running numbers on beaten down businesses while the crowd is busy panic selling them. That is exactly what I'm doing right now. I am quietly, methodically, without fanfare or a single tweet, accumulating positions in 3 specific companies that the market has either forgotten about or given up on entirely. And today I am going to show you exactly what those companies are, why I own them, and, most importantly, the precise mathematical framework I use to decide they were worth owning at all. Either you learn to think this way or you keep losing money. Those are your 2 options. If you are not subscribed to this channel yet, I need you to stop what you are doing and hit that button right now. The research I am about to hand you, the frameworks, the valuations, the specific numbers on 3 businesses I am personally putting my own capital into would cost you thousands of dollars from any professional research service worth its salt. You are getting it here, completely free, in the next 25 minutes. The only price is a subscription. Do it now, and then keep watching, because what comes next is going to change the way you look at markets forever. Let me explain to you what quietly buying actually means, because most people hear that phrase and think it's just a catchy title. It is not. It is a description of a specific discipline, and that discipline is the single most important separator between investors who build wealth and investors who merely participate in markets while slowly bleeding their purchasing power into someone else's pocket. When the crowd is loud about a stock, when it is on the front page of every financial website, when your coworker is mentioning it at the coffee machine, when the options volume is going parabolic, that is precisely the moment when the price of that business has already absorbed the good news. The math has already been done by 1,000 other people before you got there. There is no edge left. You are not investing at that point. You are paying a premium to join a party that is already halfway over. Quiet buying means something entirely different. It means identifying businesses with durable competitive advantages, strong and growing cash flows, and honest management teams. At moments when the market has decided, for reasons that are either emotional or short-sighted or both, that the stock deserves to be significantly cheaper than the underlying business actually is. That gap between price and value, that is where wealth is made. Not in the excitement, not in the momentum, not in the story. In the gap. Peter Lynch used to say that you should be able to explain in 2 minutes or less why you own a stock. I agree with that completely, but I would add one requirement to it. You would better be able to back that 2-minute explanation up with a decade of financial data, because conviction without numbers is not investing. It is wishful thinking dressed up in a suit. So let us get into the 3 businesses I am backing right now, and let us do it the right way, with numbers, with context, and with zero tolerance for the kind of emotional reasoning that keeps average investors average. The first company is Adobe, ticker ADBE. And before you roll your eyes and say you already know what Adobe does, I'm going to ask you to set aside everything you think you know about this company for the next several minutes. Because I guarantee that what the market thinks it knows about Adobe right now is factually, demonstrably, mathematically wrong. And that disconnect is precisely what creates the opportunity. Let us start with the basics. So we are all speaking the same language. Adobe makes Photoshop, which is the industry standard for professional photo editing. Full stop. No debate. They make Premiere Pro, which is how professional video editors, not hobbyists, professionals, cut and assemble the content you watch in commercials, movies, and YouTube channels that look like they cost real money to produce. And they make Acrobat, which is how the entire professional world creates, manages, shares, and signs PDF documents. If you work in any business environment of any size, you have interacted with Acrobat whether you realized it or not. Now here's the part that matters. From a business model perspective, Adobe does not sell you software once. They charge you every single month through Creative Cloud, which means once a professional builds their entire workflow around Adobe tools, their files, their team processes, their muscle memory, their client deliverables, switching to a competitor is not just inconvenient, it is operationally catastrophic. The switching cost is massive. That is what investors call a moat, and Adobe's moat is as deep and wide as any software company I've analyzed in the last 30 years. Now, the stock is down more than 50% from its all-time highs. More than 50%. That number should cause you to stop and ask a very specific question. And the question is not, should I be scared? The correct question is, has the underlying business deteriorated by 50%? Because if the business is fine and the stock is down 50%, That is not a crisis. That is a gift. So let us look at what the business has actually done. Adobe generated $10.3 billion in free cash flow last year. Their 5-year average is $8 billion per year. The revenue keeps growing. They are guiding for 10 to 11% revenue growth year over year. Their gross margins are approximately 90%. Read that number again, 90%. That means for every dollar of revenue that comes in, 90 cents of it is gross profit before operating expenses. That is not a broken business. That is one of the most profitable business models on the planet operating exactly as it should. The market's argument against Adobe is that artificial intelligence will replace creative software, that AI will make Photoshop obsolete. And I want to address this directly because it is the kind of reasoning that sounds sophisticated on the surface but collapses completely when you actually examine it. Adobe has not been sitting in a room watching AI happen to them. They built Firefly, their own generative AI engine, directly into Photoshop and their other creative cloud products. They are using AI to make their tools more powerful, more capable, and more deeply embedded in professional workflows, not lest the AI integration makes the switching costs even higher, not lower. Because now Adobe's AI is trained on commercially safe content and is deeply woven into tools that professionals already know how to use. The bear case is that AI kills Adobe. The actual evidence is that Adobe is using AI to make its products more valuable. The market got confused between the story and the numbers, and that confusion is the opportunity. Now let us look at the valuation, because this is where it gets genuinely extraordinary. At current prices, Adobe trades at approximately 10 times free cash flow. 10 times. The market average for a mediocre, slow-growth business is 15 to 16 times free cash flow. Adobe is not a mediocre, slow-growth business. Their return on invested capital has grown at 20% per year over the last decade, 27% over the last 5 years, and 38% in the last year alone. Those numbers tell you this is a business that takes every dollar it invests and turns it into significantly more than a dollar. That is a definition of a high-quality compounding machine, and you can buy it right now at 10 times free cash flow. Their price-to-sales ratio is 4.25, while businesses like Microsoft and Google, which are legitimate peers in terms of quality, trade at 8 to 10 times sales, running conservative assumptions through a discounted cash flow model, 3, 6, and 9% revenue growth over 10 years, free cash flow margins of 37, 40, and 43%, and a terminal multiple of 18 to 24 times free cash flow. The intrinsic value of Adobe lands between $375 per share on the low end and $844 per share on the high end, with a middle case around $565. The stock is currently trading around $160. You are being offered a business of extraordinary quality at a price that implies that business is dying. It is not dying. The numbers prove it. The only thing that is broken is the stock price. And that is exactly the kind of situation I built my entire investing philosophy around finding. The second company is Sprouts Farmers Market, ticker SFM. And I already know what some of you are thinking, because I have had this conversation 1,000 times. You are thinking it is a grocery store. Grocery stores are boring. Grocery stores have thin margins. Why would I ever get excited about a grocery store? And my answer to that is because you are confusing the category with the company. And that confusion is costing you money. The category's grocery retail is a low-margin, highly competitive, operationally brutal business. You are absolutely right about that. Kroger, Albertsons, traditional grocery chains, they fight for every basis point of margin in a commoditized environment where customers make decisions based almost entirely on price. Sprouts is not that business. Sprouts is a fundamentally different animal, operating inside the same general category, and the distinction matters enormously. Here is what Sprouts actually does. They run smaller format stores, deliberately smaller, deliberately focused, that carry natural, organic, and health-conscious food products, fresh produce, organic meats, specialty vitamins, natural snacks, Sprouts-branded products across dozens of categories. Their customers are not shopping on price. Their customer is shopping on values and health outcomes. And that customer is extraordinarily loyal once they find a store that matches their lifestyle. You do not switch away from a grocery store that stocks exactly what you were looking for and aligns with how you think about food and health. You go back every single week and you spend more than you would at a conventional grocery store because the products command a premium. So that loyalty and that premium pricing power together create a business dynamic that has absolutely no business being compared to a traditional grocer. Now let us look at the numbers, because the numbers here are genuinely remarkable for a retail food business. Profit margin trend, 4.2% over the last 10 years. 4.78% over the last 5 years, 5.7% in the last year. That trajectory of margin expansion is not an accident. It is the result of a deliberate strategy to grow their Sprouts branded product line, which carries gross margins of 60 to 70% compared to the approximately 39% gross margin on their overall business. As the Sprouts brand grows as a percentage of total sales, the blended margin expands. I believe there is a credible path to 6 to 8% net profit margins in this business over the next decade, which would be extraordinary for a grocery retailer. Revenue growth has been 9% per year for the last 10 years, 7% per year over the last 5, and 11% over the last 3. Analysts project 10% revenue growth going forward for the next several years. For context, a conventional grocery chain would be thrilled with 2 or 3% annual revenue growth. Sprouts are compounding at nearly 10% a year. The store count story adds another layer of conviction. Sprouts currently has between 400 and 500 locations. Their stated goal is to reach 1,200 to 1,400 stores. That means they are somewhere between 30 and 40% of the way to their long-term footprint. The majority of their growth is still ahead of them, and the unit economics on each new store are strong. They are getting a good return on every $3.8 million they spend to open a new location. They are not opening stores to grow revenue at the expense of returns. They are opening stores because the returns justify the capital. That is how good businesses are supposed to grow, running the model 5, 6, and 7% revenue growth over 10 years, profit margins of 5, 6, and 7%, terminal multiple of 16 to 22 times earnings, desired return of 9%, minus the intrinsic value of Sprouts comes in at a low of around $86 per share, a middle case of $135, and a high case of over $200 per share. The stock is currently sitting around $79. Management is actively buying back shares at these prices, which tells you they agree with my assessment that the stock is trading below fair value. Good capital allocation means buying your own stock when it is cheap. They are doing exactly that. I bought this stock in the low to mid-30s. It ran to $182. It has since pulled back significantly. The business did not break. The business got better. The price moved. And when price moves down while the business gets better, that is where I want to be. The third company is Builders FirstSource, ticker BLDR. This one is going to require you to think slightly differently, because you are not buying a technology company with 90% margins or a specialty retailer with a passionate customer base. You are buying a market leader in the supply of building materials to residential home builders in the United States at a moment when the housing market is depressed by high interest rates, and the stock has been beaten down accordingly. And the opportunity exists precisely because of that depression, not in spite of it. Let me give you the business in plain terms. When a construction company builds a new house, they need lumber, windows, doors, wall frames, trusses, and dozens of other structural components. Builders FirstSource supplies all of it, but more importantly, they also pre-cut and pre-assemble significant portions of those homes at their facilities before the materials ever arrive on the job site. That manufacturing and assembly capability is not just a convenience. It saves builders measurable time and money on every single project, which means Builders FirstSource is not simply a distributor of commodities. They are a value-added service provider embedded deeply in the home building process. Replacing them is not as simple as finding another lumberyard. The operational integration makes the switching cost real and meaningful. Now here's the macro context that gives this company a long runway regardless of what interest rates do in the short term. The United States has a housing shortage of approximately 4 million homes. That is not a number I invented. That is a documented, widely cited structural deficit in the American housing stock, built up over more than a decade of underbuilding following the great financial crisis. 4 million homes that need to be built. And the company that supplies the materials to build those homes is trading at 9.5 times trailing free cash flow and only 4.5 times its 5-year average free cash flow. Because the current period of high interest rates has temporarily suppressed construction activity and pushed their earnings below their normalized run rate. The key word there is normalized. When you are evaluating a cyclical business that is in a trough period of its cycle, you do not anchor your valuation to the trough numbers. You normalize for the cycle and ask what the business looks like in a more normal operating environment. Over the last 5 and 10 years, Builders FirstSource has generated 25 and 30% returns on invested capital, respectively. That tells you the core business, when operating at a more normal level of demand, is highly profitable and highly efficient with capital. The current trailing numbers look depressed. because the housing market is depressed, but 4 million homes still need to be built. Interest rates will not be at current levels permanently. Pent-up demand does not disappear. It waits, and when it releases, whether gradually as buyers adjust their expectations or more suddenly if rates come down, Builders First Source is positioned to be one of the primary beneficiaries. Management quality here is worth spending time on because it is genuinely exceptional and it matters enormously to the long-term thesis. Paul Levy, who has been involved with this business since 1993 and serves as chairman today, increased his personal stake in the company by 43% last year, $111 per share. He bought more of his own company with his own money at prices that are well above where the stock is today, which tells you something important about his conviction. Management also declined to pay themselves their bonuses last year after slightly missing their profitability targets, when they could have easily adjusted the numbers just enough to justify the payout. They chose not to. They held themselves accountable to a standard even when no external force required them to. That is the kind of management behavior that tells you the incentives are properly aligned with shareholders. On top of that, they announced a $500 million buyback in their most recent earnings report and have bought back over 40% of shares outstanding since 2021. 40%. They have retired nearly half the shares that existed 3 years ago, which means every share you own today represents a significantly larger piece of the business than it would have then. Running the model, 3, 6, and 9% revenue growth over 10 years, profit margins of 7, 8, and 9%, terminal multiples of 15, 18, and 21 times earnings, 9% desired return, the intrinsic value lands at a low of $145 per share, a middle case of $230, and a high case of $365. The stock is currently sitting at approximately $75. You are buying the dominant player in a sector with a 4 million home structural tailwind, run by management that eats their own cooking, at less than half of what I would call a conservative estimate of fair value. Yes, there will be volatility. Yes, you need patience. Yes, the housing market may stay sluggish for another year or two. That is the price of admission on this investment. If you cannot stomach owning a cyclical business through a down cycle, this is not for you, but if you can think in decades instead of quarters, the math here is compelling. Now, I want to step back from the individual companies and talk about why I own all 3 of these simultaneously, because the portfolio logic matters as much as the individual stock selection. I do not buy one company and bet my financial future on being right about that one company. Nobody is right about every single business they analyze. I am not. Warren Buffett is not. Nobody is. The way this process works, the way it's always worked for serious investors, is that you build a portfolio of 30, 40 companies that all meet a high standard of quality and all appear to be trading at a significant discount to their intrinsic value. And when you do that, you do not need every single one to work perfectly. Some will exceed your expectations. Some will underperform. But the aggregate result, if your process is sound and your discipline is consistent, is a portfolio that outperforms the market meaningfully over time. Adobe, Sprouts, and Builders First Source all share the same fundamental characteristics: durable competitive advantages, growing cash flows, honest management teams, and stock prices that are trading at a meaningful discount to what the businesses are actually worth based on conservative, defensible assumptions about the future. That is the process. You execute it repeatedly, consistently, without emotion, and you let the math do its work. Over years and decades, there is no shortcut. There is no magic. There is only the discipline to run the numbers and the courage to act when the numbers tell you to. Here is where I'm going to leave you, and I am not going to be gentle about it, because gentle is not what you need right now. You have watched this entire video. You now have 3 specific companies: Adobe, Sprouts, and Builders First Source, with specific valuations, specific financial metrics, and a specific framework for thinking about why each one represents a compelling opportunity at current prices. What you do with that information is entirely your decision, but understand what the decision actually is. If you take what you have learned here today, apply the process, do your own analysis, and build the discipline to buy quality businesses at fair prices and hold them through volatility, you will be on the right side of how wealth is actually built. If you close this video, go back to chasing the ticker of the week, following whoever is screaming the loudest on financial social media, and buying stocks based on momentum and hype rather than business fundamentals. You will get the results that approach has always produced, which is mediocrity at best and real financial damage at worst. I've been doing this for decades. I have watched people build extraordinary wealth by following a simple, rigorous, repeatable process. And I have watched people with the exact same starting capital destroy what they had by refusing to learn how to think about businesses correctly. The information is in front of you. The process works. The only question now is whether you're actually going to use it. Subscribe, do the work, and go buy businesses, not stocks. There's a difference, and that difference is everything.